Hey, welcome everybody back to the Presidio Perspective. I'm Dustin TenBroeck.
Hi, and I'm Luke Jacobson. Welcome back this week.
All right, got another great show for you here today. So much to talk about. I guess there's some testimony going on in Capitol Hill right now. We'll save that for next episode. We'll dissect what's going on, and we'll play back some of the fiascos that happened in the stock market and Robinhood and all that. But we have a lot more to talk about today, don't we, Luke?
Yeah, we actually have quite a bit to talk about, including Love Fest with Yellen, all the way down to the end of the bull market.
Yeah, we're taking a lot of liberty with our segments here and the choice for the titles. So when we talk about the end of a 35-year bull market, of course, everyone gasps. And when we're not talking about the market that you think of, we're talking about the bond market, right? And so we've had a 35 bull market in bonds. Everybody's most favorite and loved and adored asset class. Right. I mean, everybody just asks us, can I get more money in the bond market? Right.
That's right.
I don't think I've ever heard that in my career. I think in fact, I meet most people who are, been alive for 50, 60 years and really could barely tell me what a bond is. And I think that's normal. Right. I don't think that's something that it doesn't make the headlines when you're watching. If you tune into financial markets and television shows, there's very little talk about the bond market. But quietly, there has been a 35-year bull market in bonds, which investors, whether they know it or not, have fared well with that. And we see a reversal or an end to that bull market. So, Luke, you want to talk about what our concept is there?
Sure. And to add to that, we actually had a response from one of our listeners. I mentioned getting my first mortgage at, say, I think it was 6 7/8. And we had a respondent come in and say, 6 7/8? Oh, my gosh, my first mortgage is at 15, 16%.
Yeah.
So when we talk about an end of a bull market, like that would be a reference point. Think about the time when you bought your first house, potentially in the early 80s, when interest rates were in the mid-teens versus getting your mortgage today at 3.
Yeah.
And so the inverse relationship of bond prices and interest rates, that's what we're talking about. Bond prices have moved in a reverse direction since the early 80s up to peaks now. And so now we kind of figure out which way do we go. To kind of intersect that with what's going on today, the 10-year yield, which is a benchmark of the U.S. government loaning out capital for 10 years, started the year off at 0.93. Yeah, 0.93. And right now it's sitting right below 1.3. Now, that doesn't seem like a giant step, right? That's only 0.5%. But the rate of change there is 40%. Mm-hmm. And so when we think about what's happening in the bond market and how that's impacting stocks at high valuations, it's something that this is kind of unknown territory.
Well, one of the things that we know, and we should explain to our viewers there, is that bond prices, right, have an inverse or opposite reaction to interest rates. And so what Luke's talking about is since the early 80s, when interest rates peaked, right, and some of you who were buying real estate back in that time remember those crazy rates you paid on mortgages. You remember the first time maybe you got a mortgage for less than 10% and you couldn't believe it. My stepfather was a mortgage broker during his career, and he remembers and recalls a time when he locked in an attorney client of his at 10.5%, and he said, "Hey, Bart, you call me if the rate ever drops below 10." And he said, "Yeah, dream on, buddy. Like that'll never happen. This is a once in a lifetime, opportunity." So it's crazy how things change, right? And our perspectives change. But what we've had is falling interest rates for 35 years, which mean that bond prices go higher.
That's right. That's
right. And so if I have a bond that pays 5%, right, and so I can borrow money from you and I'll pay you 5%, and then Luke says, "Hey, I'll offer you 4%. Which bond are you going to want to have? You're going to want to have mine at 5. So mine's going to get priced higher. Luke's is going to get priced lower because he's only paying 4, right? So falling interest rates mean that bond prices are higher, and we are at or near the bottom, right? There's some speculation of can interest rates go negative in the bond market, which we saw, which has to be, a sign of the bottom of the end of a bull market. Right?
Sure.
I mean, how much can you really flirt with that? So if that's not a tale of the end of the bull market in bonds, I don't know what is.
Well, and I don't want to delve into the theory of negative interest rates. I mean, we've seen that happen in Europe. It's not really worked great.
I know you, Luke. I know you kind of do.
I don't want to go into
that.
it. No, I'll let Gunlock go into
Okay.
negative interest rates and let him opine about that. We haven't done it, so all we can do is just move forward and say we witnessed it happen. It doesn't seem like we're going there, but we did hit zero bound. And if you want to just call that an end to the bull market, I think that's great. It's like we hit the floor.
Yeah.
So year to date, the aggregate index for bond prices is down nearly 1.5%. So to just put it in perspective, what it means for interest rates to rise and bond prices to go down. That's if you want to get really tangible value, the value of a bond that you held at the beginning of the year is now worth 1.5% less.
Yeah. And I'm sure a lot of our viewers, listeners, clients are wondering, so why would I be in bonds, right? Why would I invest in bonds at all? If this is the end of a bull market, right? Interest rates have been falling and now we think interest rates are going up. Why would we own bonds? First of all, during the 35-year bull market, everyone pretty much asked that question anyway, right? When all the economics were there. But to put it in perspective, we own fixed income or bonds for two reasons. One is for income, which there is none today, unless you get the really risky bonds, which could be called high yield bonds or long maturity bonds. And even those don't pay a lot of interest, but at least some. And the other is for safety, because bonds are loans, and loans have a guarantee to pay back the principal so long as that company or government or institution is still around, right? And so there's a pledge of collateral and security that they will be around to pay you back all your money on a guaranteed basis. When the stock market goes down, people get nervous and fearful, and there's this flight to safety. And so what investors do when the stock market goes down is, of course, they sell, right? A good amount of investors are going to sell potentially at the very worst time, and that's just what happens.
And what happens when a lot of people sell one item? What typically happens to the price of that item?
The price is falling.
That's right.
And where does that money go? It pours typically into the bond market, right? And what happens, conversely, if you're selling one asset, that's going down, and you're buying the other asset, that asset is going up. And this is why we recommend having, a balanced asset allocation that's geared towards your financial plan. So using mathematics to gear towards your asset allocation for your personal financial plan to know exactly how much money you should have in equities or fixed income or other assets. Right. But they're going to have a nice balance in relationship to one another. So one of the things that we prescribe to is that if you think of why you're investing in fixed income, it's for income and safety. Well, there's not a lot of income, so primarily we're looking for safety.
That's right. We're looking to build a portfolio that doesn't have a correlation of one across all asset classes, right? So while assets are moving in one direction, we would like to have other assets that potentially move in a different direction. And while that doesn't make sense that you don't have everything moving in tandem in a bull market, it makes a lot of sense, say, in March of last year.
Right. And so a correlation of one, meaning everything moves together, versus a correlation of negative one means they would move directly opposite. So we want somewhere in the middle there. So what we want to be wary of is investors looking at bonds as investments to make money. Look, if you want to make money, our opinion is you should be a long-term investor and invest in the stock market, right? You can make money over long periods of time, so long as you can tolerate the risk associated with that stock market. You stay diversified. You can build tremendous wealth, as just about everybody on this call likely has seen over their lifetime over a long period of time. However, in short periods of time, you're going to need something that you're able to sell, especially if you're in retirement. We can't just not take money out of our portfolio once we retired. So we need to have some fixed income for some safety, right? And so that is what we want to focus on when we're looking at fixed income. We see a lot of our peers, right, looking at fixed income as an asset class to make money, and are going out and outside of the credit profile or the risk profile to get riskier and riskier bonds in an effort to make a couple percentage points. And we think that is likely foolish. You should look at making money where your money-making investments are, like investing in stocks and equities, and look at fixed income as your safety to allow you to continue to invest aggressively with the other parts of your portfolio.
That concept of reaching for yield that you just talked about, I've heard people speak of that as picking up pennies in front of a steamroller. I really like that concept, that as they're reaching for yield, it's pretty you have a guaranteed problem sitting right in front of you, just reaching for just a few more pennies. So if you think about it,
but you could probably move away from that steamroller.
Maybe,
right?
Maybe get those pennies.
Yeah,
so,
but the consequences are so great, and the reward is so little. So even if you end up making it away from the steamroller, is it really worth it? That's a good. I like that too.
So let me ask the question: why are we here? Why are we at zero bound? And that really pivots great to the next segment, which
because of a love fest.
It's because of a love fest. Did we arrive at a love fest? So, so why are we here? Why are we at zero bound? It's because we've had massive monetary policy actions over the last decade, and I think it's important to walk all the way back to the last decade, because what's happening today in this environment is remarkably different than what the Treasury Secretary did in conjunction with the Fed chair in 2009. So there is one thing that's very similar today versus 2009. The one party owns all of the Congress, presidency, and what am I missing here? Basically,
Senate?
they own this. Yeah, so they own the Senate, and so that's the same as in 2009. The difference is in 2009 we had 8% unemployment from the Great Recession, and the target opportunity there was to change healthcare. And so they really took a great opportunity because they had majority vote. They really wanted to push through massive legislation and focus on getting something done that was really important. That being said, there was something the economy really needed. It needed to fix unemployment. And so we saw below average GDP growth rates through pretty much the entire movement from 2008 to 2020. And a lot of that was because we focused on different things of what the economy potentially needed versus today. Today, you're hearing Jerome Powell, our Fed chairman, say specifically that unemployment is stated at 6%, and he thinks that if you added back people who have been reclassified, we're closer to 10. Now, as he speaks that, you hear from the other microphone and on a different podcast, Janet Yellen, the Treasury Secretary, who, by the way, used to be the Fed chairman. Mm-hmm. So these two have a very, very intimate relationship, understanding what they're supposed to be doing. One is monetary policy, one's fiscal policy. And instead of working on fixing social issues right now at this particular moment, they're really focused on unemployment. And that is remarkably different than happened in 2008. And they're specifically saying that we're going to target, they want to have low unemployment and targeting inflation around 2%. So they made a change last year. Instead of keeping inflation below 2, they were going to average 2 to let it move above. But they're really targeting unemployment. And basically, you have seen Powell's testimony last week say specifically that they're going to keep the pedal down as far as monetary policy works. And you have Janet Yellen with the executive branch that effectively is pushing on fiscal policy. So you'll have the two working in conjunction instead of what we had in the beginning of the last cycle. You had fiscal policy working on different issues such as healthcare, and you had monetary policy with the pedal all the way down. That's a dramatic change, and what we experienced just cycle over cycle. And what we're seeing from that happen even yesterday, just producer price index was over 1% month over month. Mm-hmm. So you're seeing prices ramp across the board. We're seeing stimulation of the economy and just a lot of dollars chasing lesser opportunities relative to the amount of dollars being printed effectively.
And so what does this mean for us and for markets?
So for markets, we're seeing it. So we were in our meeting the other day, one of our participants mentioned the impending doom. Mm-hmm. What's the impending doom? And always looking around the corner for that spooky item. And the reality is that we really need to look at what is being messaged to us, that our policies are extremely stimulative. And remember, we raised our M3. We talked about this a few weeks ago, maybe a month ago. We talked about our money supply and how much we've ramped that up over the last 6 months, 9 months. So that's our particular currency. And China, on the other hand, has ramped theirs up 2x
Yeah.
what we did.
Right.
So there's more money chasing the same amount of objects and businesses. And what it means is that asset prices are moving higher.
Yeah. And that's going to dovetail well into our last segment of the day where markets are at all-time highs.
That's right.
And why that might be, right? But yeah, capital is cheap, well, pretty much free, right? There's no cost to borrowing capital. Banks don't have to really pay money, overnight lending. Even we talked about, I know I saw a client get a 30-year mortgage at 2.25% last week. I mean, it's just insane. Wow. The interest rates that people are paying to borrow money for 30 years. That's intense. Right? And you have to subtract inflation from that. Mm-hmm. And then you have to subtract the tax benefit from that, since it's tax deductible likely. Mm-hmm. So, I mean, you are at a real return borrowing money.
You are.
I mean
2.25
minus a 2% inflation, minus whatever tax benefit you get on that 2%. So call that minus, another 0.7. I mean, you're positive 0.5% borrowing money. Mm-hmm. I mean, we are incentivized to borrow from the future and invest today, and that pushes asset prices higher. So again, we'll talk more about that. But I think it's interesting. I'm glad you mentioned the PPI. In fact, if we could take a note of that to monitor that in future segments, I will do so, because I think something that we obviously focus on a lot in inflation, what the government is going to tell us is about the consumer price index, or CPI, mm-hmm. which is basically the variable rate on their debt on Social Security, right, mm-hmm. which is trillions of dollars. Mm-hmm. And that is a flexible basket of goods and services, of course, not a fixed basket. So what goes into consumer price index on an annual basis can change. Mm-hmm. And so many would argue is not a great indicator of inflation.
Actual inflation. Actually, kind of what you feel. I know that my restaurant check, at least the other day, seemed to be 30% higher than it was a year ago.
So I don't have the restaurant check index, but I can tell you that looking at as the end of last month, uh-huh. right? You look over a 1 year, you have the S&P 500 index, right, up 18.55, the NASDAQ up over 46, emerging markets up almost 32. You have bonds, the aggregate bond index up about 4.5. You have munis up 5. You have gold up 16. You have commodities up 12. Mm-hmm. Yet we've only had 1.9% inflation. So how do you get to that math, right? So the Alarian MLP index, right, was down 15, so maybe that's part. REITs down 5. So if you're in oil and real estate, they must be a big part of that index. Mm-hmm. So anyway, we think that the love fest continues. They have, if you look at the Fed, both Yellen, even going back to Bernanke, they've told us what they were going to do, and they've pretty much stuck by it. I would say the first deviation that I can remember is this abandoning of this 2% inflation target, where once we got close to achieving that, which would be the sign to start tightening the belt, right, around monetary policy, mm-hmm. is they said, no, we're going to let it go, which is something we theorized in last year.
So the number with producer prices, this I don't want to belabor producer price index, but the number yesterday was gargantuan. It was enormous. And even at that, it was only 1.3 mm-hmm. relative to an average of 2%. Mm-hmm. So we still have, the market struggled with that yesterday. It's digesting new interest rates, new elements of inflation. It's digesting all these new concepts. But the reality is we're still a long way from 2%. Yeah. And so there's room for inflation to run and for us for markets to digest the impending inflation that really is starting to move down the pipe. So if you think about, we have this next segment just talking about, as it relates to the Port of Long Beach and inflation, right? So you have this massive purchase effectively of individuals who are buying tangible goods instead of services. And so you have massive inflation that's going on in acquiring all sorts of goods and services. And right now you have 62 ships in the Pedro Bay where normally you have 0. Yeah. You just have this massive pig in a python that's coming through the system. I think that's just a great analogy of what we should expect for this producer prices moving into your grocery store, moving into the gas tank, moving into your kind of everyday life.
Yeah, we had a client telling us the cost of his containers were up 900% or something like that, right? Over
It's
the last
pretty
month.
crazy.
Yeah.
Yeah, it's pretty crazy. And there's lots of factors for it. Part of that is actually COVID and vaccination. So, for example, there's 800 people in Port of Long Beach out of 15,000 that are out of work because of coronavirus right now. And right now, they said that if they stop bringing incoming ships into the port, it would take them a month to offload all of the vessels that are sitting outside. So you have this massive pig in a python that's coming through that's creating more inflation and more demand for those ships to return back to overseas areas to bring those goods back. And so I think we're just going through a pretty dynamic state of change.
So there's supposed to be 15,000. There's only 800 there. So that leaves 14,200 that signed the Newsom pledge to get him
Yeah, right.
out of the governor's chair.
That's right.
Yeah, right. Okay. So, and then how are we doing on the vaccinations?
So vaccinations, actually some great data came out from a research team at Goldman that just talked about how we're still on track and actually improving dramatically about when we think an X amount will be vaccinated. So there's about, I think, roughly kind of low 300 million residents in the United States, and the expectations are we would have 200 million vaccinated by the end of June. And the expectations are is that the odds of that stand at around 90%. And those odds has changed over the last 30 days from 30% to 90. That's pretty dramatic. So we think about, like, let's just use the Port of Long Beach as an example. The quote taken from the president of that association said specifically, consumers are out buying product instead of services. So let's fast forward to the end of June. How many people are going to be sitting at home just buying products versus buying services? We're likely to see a very dramatic change in purchasing behavior, even in just the next 6 months.
Yeah.
Right? That's that. And will that change prices? I don't really think so. I think that we have more money in the system.
And you mean prices as far as like stock market prices? And
stock prices, even just inflation. So is that does that mean that as we move away from just shopping on Amazon and potentially go on vacation, are all the prices on Amazon going to go down? Probably not, right? But we are going to see a huge change in behavior.
Yeah. All right. Let's see how we are on our time. Good. I think we have time. We have a call-in segment here today where we had a client of ours call in over the week. So some of you might see this in future segments. If you get that email, you want to respond, you can go ahead and call in, ask your question. Luke and I will answer it live here during the show. So we have a call from Dan, I believe. Are we queued up, Sierra? All right. Let's hear it.
Hey guys, I got a quick question. Maybe the answer is not so quick, but hopefully it is. So I have a solo 401k that I contribute to, and I know that you can contribute 19,000, I believe 500 in a traditional 401k. But when you have a solo 401k, you can stock away even more than that because you can contribute, I believe, like the employee's portion. So how does that actually work, and how much can I contribute? Yeah, I'd love to hear about that. Thanks.
All right. Great question. I'd say it's a timely question right now, too, being that it's February 18th and we have about 2 months until tax time, a month until the corporate returns are due. And so this is where a lot of business owners are looking at sheltering and maximizing their pre-tax savings, right? And if not pre-tax, maybe it's a low year and you can set up 401k and pension plans and SEP IRAs to maximize your tax-free account, right, which are called Roth. So we'll save that conversation for another day. But for the contribution limits that Dan was asking about, I have solo 401ks are a great way for individual business owners to really maximize their pre-tax or tax-free savings using their retirement plan called a solo 401k. It's an individual 401k account. Now, the caveat is these need to be signed and set up before the end of the year. So if you are looking to contribute to a solo 401k, you would have had to sign those documents by December 31st of 2020 to be able to use it for that year. Now, you don't have to actually fund the account until this year, right, until your tax filing deadline, but you would have to have these accounts set up. And if you did that, you could contribute up to $58,000 of either tax-free or pre-tax money. When I say tax-free, this is after-tax money that you pay taxes on today that goes into a tax-free Roth IRA bucket, potentially tax-free. So So anyway, we'll just use a pre-tax savings as for the rest of this conversation. So you could put up to $58,000. So that's, Dan was correct. There's $19,500. That is the employees portion, and then the employer's portion. If you're self-employed, you're both people, right? Could put a profit sharing component away, which would go up to $58,000. If you are over the age of 50, you can put an additional $6,500 away, so that $58,000 turns to $64,500. So those over 50 can do what's called a catch-up contribution. Maybe they haven't been putting away as much as they should have, so the government allows them to put a little bit more away to catch up and save for retirement. So if you weren't on the ball last year, did not get your documents signed, you don't have your 401k set up, and you are self-employed, what you could also look at doing is open up a SEP IRA. So this year, self-employed individuals might be able to look at opening up a SEP IRA, which would also allow them to contribute a 25% profit share that would go up to that $58,000 limit too. So there's some limitations as far as what percentage of the income, right, that you could put in. But if you had a really big year, and so what am I talking about? You're making $230,000 last year or more, you could put away up to $58,000 into a SEP IRA. So great question from Dan. If you do need some tax planning tips and advice and talks, make sure to meet with your wealth manager here in the next coming weeks to get prepared for tax time here, and always work in concert with your CPAs as well. So great question from Dan. Glad we have that segment. We look forward to getting more calls from you guys in the future on things that you want to know about, and we're always interested in talking about the things that matter most to you. So great question from Dan. And then let's talk about topic 4, the segment I'm excited about, is something that we're hearing about a lot, is these markets are at all-time highs. There's a lot of, the fear index is high, maybe not high enough though, but still a lot of talks about all-time highs in the market and what to do.
Well, it's interesting. So we started with the 35-year bull market is ending, and here we are now at all-time highs. And I think, what's the thesis that 10 of the last recessions that never happened were predicted, or how do people think about that? Basically, people are always trying to predict recession. I totally botched that.
Well, it's when you talk about bond investors. I think I remember hearing it in the terms of Bill Gross, who was the famous bond king for years, right, before dethroned by Gundlach. But he was famed for calling 10 of the last 2 recessions.
That's right, 10 of the last 2 recessions.
Yeah.
And so there's always
recessions are different than I think what we're talking about,
pullback.
right? So recessions are an economic factor, and we are talking about just the prices in markets today, right?
Right.
Whether it's cryptocurrencies, U.S. equities, whatever you want to talk about.
Well, news alert, prices don't go up in a straight line forever, right? So there are pullbacks. So we do have corrections, which would be kind of your normal market corrections around 10%. And so I guess the message is that bull markets are built on all-time high prices. If you don't have all-time high prices, you don't have expansionary environments.
Yeah.
And so it's while it may be concerning to hear all-time high prices all the time, and there tends to be a bias to run from all-time prices, there's a really good reason to actually be really happy about all-time prices and not be entirely fearful about it.
Yeah, and so all-time prices, that's a great comment. And what I usually say is that if the markets worked perfectly, all-time highs would just be the thing that occurs every single day. Right? That if everything was perfect, that's likely what would occur. What happens is we overshoot and have to correct.
That's right.
Right? Because it's hard to tell, right? There's a lot of factors that go into place. The markets are pretty efficient. You see how quickly they react to new information. And it's rapid fast, right? And so it actually, when you delve into it, it makes a lot of sense what is happening in the market. And when we feel like the market's dislocated from reality, it's usually us, right? And the market is pretty in tune of what's going on. Just look at this last year and how many lessons we've learned and watching how the market reacted. But anyhow, so there's just so much reaction. So all-time highs, like you say, are typically a good thing and the sign of what happens in a bull market.
And especially for those individuals who actually have a portfolio that is correctly built to meet the needs of that particular household, such that the risk tolerance that they exhibit as a household is in line with their portfolio. You know what I'm saying?
I do. And we've talked about it a lot of times, and still what we see is investors that are having large cash positions in their portfolio. And again, this is an issue that needs to be addressed if you are one of these individuals.
So let's just talk about that really quick. So if you have cash in your bank account right now, because we just talked about consumer price index, the PPI, we talked about Jerome Powell and Yellen. How much does it cost you every year right now to have cash in the bank? If you had $100 in savings, how much does that cost you this year?
So the dollar index over the last 12 months is down 8.65.
So that's even just in dollars. But if we think about just in inflation,
right,
it costs you $2 every year to have $100 in the bank. That's a 2% fee.
Yeah.
That is charged effectively every year by the U.S. government for being part of this wonderful growth engine we're part of. I think it's really important to think about that.
And I think that's just the fee they tell you about.
That's right.
I think the fee might be 5 or 6%, right, when they're telling you to.
Yeah. So I think it's really important to put that into context about having cash in the bank, being really nervous about capital markets. There's portfolios that fit all sorts of varieties of risk tolerances in households. And I think instead of comparing your bank account to nothing, as we consistently talk about in our classes, I think it's really important to compare spending 2% every year to keep your capital in the bank to potentially adding some risk that fits your tolerance to potentially offset the loss of 2% every single year.
I've spoke about this for years with clients, but just imagine what would happen, Luke, if we somehow passed a law that regulated banks, financial institutions to report what the real value of the dollars were on an annual statement. Like when you got your annual statement, the bank had to tell you how much less money you had in the current dollars than you did in the beginning of the year. And investment accounts as well, right? It should apply across the board. But just imagine how that would change our behavior, because that is the reality. Our defected brains don't understand how inflation works. Even though we are financial professionals, we still don't look at math at the end of the year as being different than the dollars that we were talking about at the beginning of the year.
I can just hear the banker saying, don't pay attention to the man behind the curtain.
Right. And it'd be incredible the change that would occur in our behavior if we understood what inflation was. And look, it hasn't mattered all that much over the last 15 years. It really hasn't, right? If you didn't pay attention to inflation, you weren't hurt that bad. But the next 15 years, I will theorize, are going to be very, very different, and it's going to happen quickly. Quick anecdotal story. My father and my grandfather in the 70s had inherited some money, and I believe it was something around $40,000. Now, I'm from Palo Alto, Mountain View, Silicon Valley, so kind of a tremendous real estate market over that time period. Yeah, right. And housing prices started to go up with inflation in the 70s, and he said, oh, this is ridiculous, right? I'm not buying right now. I'm going to wait for it to come down. And before you knew it, he lived the rest of his life in a one-bedroom apartment, right? I mean, where he could have afforded a really nice home in Palo Alto that would have turned into millions of dollars, right? And that's just how quickly inflation took hold in the 70s and 80s and what can happen. So pay attention to what Luke and I are talking about with this Yellen and Powell love fest and interest rates being low and monetary policy and printing of money and what that is going to do to inflation, and make sure that you have an answer for your portfolio. One of the things, I know we're running over on time, but I did want to talk about, and thinking of market at all-time highs, I don't think is necessarily news or something that I'm paying attention to as anything of a concern. That's a good sign of the markets. I mean, if we're not at all-time highs, then yeah, you obviously know that there's more growth to go. And once you're at all-time highs, okay, how long is this going to go before the next major correction? But should be a while. But one of the things we're starting to see is, and questions that I believe you and I are going to be addressing over the coming months and years, is are we in a bubble, right? And that is something to pay attention to, right? Is are we reaching a bubble? And I think I have a nice little something I want to share with you all on the bubble, if we can pull that up, Sierra. But this is something that we have seen over our careers. And something that I've been asked about my entire career, every year since 2008, certainly, everybody has told me that the stock market is going to crash, right? And they've cited all kinds of metrics, right? The Case-Shiller index, people telling me about, 4 years ago, and all these things to say that we're in a bubble. I mean, look at these headlines since 2010, right? U.S. stocks surged back towards bubble territory from Business Insider, January 11th to 2010. Can you imagine being in a bubble? Like, what are the economics that say that? The next year, 2011, every single year since 2010, we have a major financial publication, right, talking about the stock market bubble, right? 2016, is the stock market in a bubble again, right? Is the stock market a bubble in 17? Epic market bubble is ready to burst in 2018. I mean, and just, I wish I should have pulled up a graph of the S&P 500 and plotted out all these dates. Maybe we'll do that for you next week or in 2 weeks in our next podcast. But oh my gosh, what if you paid attention to this? So calling for a bubble and watching bubbles in the headlines is nothing new. We always experience headlines saying that we're in a bubble because that's going to get some clicks and that's going to get some viewers and some readers. So, maybe we should remember that when we're producing our show and make sure that we put, is this going to be a bubble on our next show, and everyone will tune in, right? One of the ways that I guess you can explain, or define a bubble, right? And I think of the last two bubbles, right, Luke, and you'll remember the .com, right, in the early 2000s, and the housing bubble, right, of 2008, right, which 2006, 2007 housing bubble that crashed and created the Great Recession. And what you find is you have this rapid growth in asset prices, right, that become dislocated from the inherent value of that asset, right? That's clearly what happens in those bubbles. And when we look back, hindsight is 2020. But if you looked at .com stocks in the late 90s, right, they became completely dislocated with their asset values. If you looked at home ownership, the people who were buying homes, I mean, college kids were buying homes without a job because they had a good credit score.
You're talking about in 2005, 6,
in 2005, 6, and 7, right? Sorry, hop to the next bubble, right? But if you look at these two things, and they became completely dislocated with reality. Now, the other part of a bubble is that we can't see it coming. You have to have participation from the masses that say there is no bubble. And I clearly remember, I was in Silicon Valley during the .com bubble. I was in Southern California during the housing bubble, so probably the epicenter of the two, right? And just seeing the dislocation of what was
I'm going to move to my left
away,
here.
right? What's going to happen in San Diego now? So, but I just remember folks just saying, why would I invest in anything else except for growth stocks? Why would I invest in anything else besides real estate? It always goes up, Dustin. It always goes up, is what investors were telling me. And so that dislocation from reality, and we see this happening a little bit, right? Or a lot, but we have to look at, these dislocations from the inherent value of the asset. So I think of cryptocurrencies, right? You think of some of the stocks out there today, think of why they're trading at their prices, and it seemingly does not matter. The other thing that happens in these bubbles is people talk about a new normal. People will convince you that, that was the old way, right? And in the late 90s, they said, no, there's a new era, right? This is the new internet age. This is a new era. Companies don't have to make money.
It's different this time.
It's different this time. And then 2006 and 7 is the same thing. No, it's different now, right? Real estate is going to continue to go up. You just need to keep leveraging yourself to buy the next one, and that's how you make money.
Yeah. So I think to think about, like, when you just mentioned .com, I immediately just thought about the S&P return of that time frame where we had sort of a bear market correction and how the S&P performed. I don't have this memorized, but how the S&P performed relative to the NASDAQ. NASDAQ were very much the .com stocks of that time. And I don't know exactly what it was right off the top of my head, but it was the downdraft in S&P was a fraction of the NASDAQ. I think that's really what I think of when you speak about these particular bubbles. Is I think of the whole market as a pie, and there'll be small slices of the pie that do have corrections that are substantial as they move back to their fundamental value. And other parts of the market may not correct at all. So I think that just speaks to the value of thinking about your risk tolerance and having a portfolio that keeps you invested. Because another thing you also said is that over time, markets have proven to build wealth, especially over long-term time frames, such as 5 to 10 years.
And I also want to go on record saying I'm not calling this a bubble, right? And
Right.
one of the things that, but something to pay attention to, I guess, if you could theorize that, the masses will not be able to see the bubble because by definition, the masses have to participate in everyone buying, right?
It's a trapdoor event.
But what we might be able to see is the beginnings of one, right?
Mm-hmm.
And I think that this might be somewhere where we are. Mm-hmm. Interesting, I saw this E-Trade survey that was recently done. So E-Trade sent out a survey to its investors. 2/3 of the investors believe we are in a bubble. Another 25% agreeing that we are near one. Okay? So 2/3 and then 25%. So what that means is 9 out of every 10 respondents to this survey believe we are either in or near a bubble. Now, that response leads me to believe we are not.
That's very fair.
Right? Mm-hmm. And especially as we still see portfolios sitting in cash, we know we're not. Mm-hmm. Right? We haven't seen the end of the bond bubble. Mm-hmm. What happens? What do people do when assets, start falling? They sell. Mm-hmm. What does that do to the price? Sell. So what happens when bonds start falling, right? Same thing that we talked about when stocks start falling. Still a lot of things to push this market higher.
Right.
Not to mention vaccine rollout, all these things we're talking about. So, and bubbles get created over time, but something to pay attention to. No, I don't think we're anywhere near the thoughts of being in a bubble, right? You might see little pockets pop up in markets that are relatively small to the overall market, like in certain cryptocurrencies, certainly.
Sure.
Right?
Sure.
But the overall market, no. But maybe we're seeing the beginnings of where one could be created and something for us to watch and pay attention to.
We're definitely in a period of digesting all sorts of very different data points.
And that's why we are here, to give you our perspective, the Presidio perspective. And so I hope you enjoyed the show. It was a longer one today, but again, had a lot to cover. Hope you'd enjoyed it. You can follow us on Facebook and Instagram if you want to get. We have lots of posts and that we're going to do coming up about our podcast, letting you know special shows, all the content, helpful tips and tools. And of course, you can subscribe to our YouTube channel to make sure you never miss an episode and are able to catch the replays once they are available. So, Luke, always a pleasure.
All right, Dustin.
Okay.
Cheers.
Cheers, everyone.
Thanks for tuning
Thank you.
in.
We'll see you next time.